Welcome. My name is Molly Nicolai, and I'm with the Appalachian Sustainable Agriculture Project. We can go to the next slide. Today's webinar is really focused on crop insurance and helping you give an overview of what crop insurance options there are for farms in our region, and really determining if that is a good option for managing risk for your farm. Our primary speaker today is James Robinson from RAFI International. He's a research and policy advocate. I'm the program director for ASAP's local food campaign, and this webinar series is brought to you through some funding from the USDA Risk Management Agency and in partnership with RAFI, Farm Service Agency, Cooperative Extension, and ASAP. Next slide. James will give a little bit of an introduction of who RAFI is and what kind of work they do. ASAP is, for those of you who aren't familiar, we are a regional nonprofit serving the Southern Appalachians, and our mission is to help local farms thrive, link farmers to markets, and support and to build healthy communities through connections with local food. And feel free to visit our website or call to learn more about the services and materials that we offer. Next slide. This series of workshops is designed to help farmers in our region manage risk for their farm. When I ask people about how they define risk for their farm, people usually talk about crop failure and weather or insect damage. And yes, this is what we call production risk, and that's what this part of what this webinar today will be addressing with crop insurance overview. But other types of risk include marketing risk, financial, legal, or human resource risks. And no matter what type of risk we're looking at, we're talking about planning as one of the primary ways to reduce these risks. And being part of workshops like these today will hopefully offer you a look at some of the options you may have for reducing risk for your farm. Next week, we'll be looking at options for managing financial risk through accessing capital for your farm. That can be connecting with loans or grants or cost share programs. And then on the 24th, we'll be focusing on managing marketing risk, which is more of my area of expertise, and we'll be discussing strategies for diversifying your market options and focusing particularly on local markets and branding your farm as certified local. So please check out those other webinar series. Today is a recorded webinar, so there won't be the opportunity for you to ask questions live, but feel free to email James or myself if you have any questions. So I will hand it over to James now.
All right, well, thanks, and welcome everyone to this recorded webinar. My name is James Robinson. I work for the Rural Advancement Foundation International. We are a nonprofit that's based in Pittsburgh, North Carolina, that does work with family farms around the country. Primarily, we work with farmers who oftentimes end up in some form of financial crisis, and we try and do what we can to help that farmer stay on their land and pass that farm on to the next generation. And all of our other programmatic work is really in one way or another designed to make sure that we see fewer farms in financial crisis. But to sort of put it another way, you can see on the slide here that RAFI combines on-the-ground services with policy and market advocacy in order to ensure that farmers have the opportunity to make the right choices for their farm and families, and that these are also the right choices for the environment and farming communities. So that's RAFI in a nutshell. So what are we going to talk about today? Well, this webinar will be split into 3 sections. I will give a brief overview of crop insurance and talk a little bit about why RAFI works on crop insurance and why it is important to us, and why we think it should be important to farmers and to our agricultural system. The next section will look at whole farm revenue protection. This is a new policy that was made available for the 2015 crop insurance year and is in a 3-year pilot right now. and we'll give an overview of that, and we will also look into the changes that have been made to the Non-Insured Crop Disaster Assistance Program, or NAP. That program has seen some significant reforms as a result of the 2014 Farm Bill, and we'll talk about why those may be important for your farm. So crop insurance, an overview. Why does RAFI work on it? So let's start with the overview. Let's say, for the sake of simple math, that on average your farm earns $1,000 in revenue, and this is what's expected in 2015. And you decide that you want to insure that revenue, and that you want to insure it at an 85% coverage level, meaning that you want to insure 85% of that revenue. Well, to figure out what is going to be covered, how much revenue you can guarantee, it's really simple math. You just multiply your $1,000 in expected revenue times your 85% coverage rate, and you get $850. And that's what you can expect to make based on what your insurance guarantees, what you can expect to make at least. So let's say that hail hits a week before your harvest this season, that you've bought 85% coverage, and it wipes out 50% of your crop, leaving you with $500 in revenue for that year. Well, $500 is certainly less than your $1,000 in expected, and it's also less than your $850 in insured revenue. So let's take a look at what that means. Here's the chart on the right that shows $1,000 in expected, $850 covered, and $500 in actual revenue. That's what you actually made after the loss. And in this scenario, you would get a $350 indemnity payment because you would be brought back up to that $850 coverage level. That's the guaranteed income that you had based on your crop insurance. So just to make sure that we've got how crop insurance works, let's take a look at one other example. We've got the same $1,000 and same 85% coverage level, but this time around you have minor flooding in a single field that brings your revenue down to $900. And in this scenario, your $900 is actually above your $850 guarantee based on your coverage level. And so in this case, you get no indemnity. So you would pay premiums for the year, but you would get no indemnity, much like you pay premiums for car insurance, but hopefully you don't get in an accident, and so you wouldn't have to file a claim and collect on that. And that's what we see in this particular scenario. You've paid premiums, but your revenue didn't drop below that coverage level, so there's no indemnity payment. So now that we have this understanding of sort of the very basics of crop insurance, let's talk a little bit about why RAFI works on this. Why is this important? And to put it very simply, you can look at what's written here on the top of this slide. The structure of lending and crop insurance programs drives investment and production decisions long before a disaster takes place. What that means is that crop insurance is important for two reasons. It's not just a safety net. While the safety net that it provides is very, very important and is a worthwhile thing to provide in and of itself, it's not the only thing that crop insurance does. It is also a tool for farmers to build their creditworthiness because you can collateralize your debt with crop insurance. So this graphic here in the middle of the slide will explain some of the challenges that farmers have faced based on the historic structure of crop insurance. So historically, we're going to start here on the left, in the left box, under crop insurance. Historically, crop insurance has not been designed to cover specialty crops, diverse operations, or livestock producers. And creditors, historically, have had limited recognition of production-based risk management, like crop and income diversification. When we say production-based risk management, we mean things that farmers do to internalize their risk, like diversifying their crop income across crops, or planting cover crops in order to ensure that they have better yield results during droughts. And because creditors have not historically been able to quantify the benefits that you get from these production-based risk management practices, they have required crop insurance. And so the farmers have a decision to make. With the sort of full range of options that you have as a farmer to be a specialty crop farmer or to be a row crop farmer or a livestock farmer, farmers have taken those options and realized that many of those options, like growing specialty crops and incorporating livestock into production, aren't going to help them access credit because it's not going to ensure, they're not going to be able to get insurance for it. And so farmers find that there are limited credit opportunities for these specialty crop and diversified and livestock operations. So when we say the structure of lending and crop insurance programs drives investment production decisions long before disaster takes place, that's what we mean. Farmers are making decisions based on the kind of crop insurance that's available before disaster ever takes place. So what does this mean for especially crop and diversified and livestock farmers? I mean, there are significant impacts that this structure has. One is that if obtaining credit is difficult for specialty crop and diversified producers, then it's harder to access land. It's harder to get a farm ownership loan. Producers are more likely to farm under production contracts, and production contracts are a way to have some guarantee in income, but oftentimes we find are not fair deals for the farmers. And it's harder to expand operations. So if you have a really interesting idea, but you need credit to help you put that idea into action, the lack of crop insurance and risk management programs is going to make it more difficult for you to access credit and implement that idea and expand your operation. So this brings us to the two products that we're going to talk about today. Whole farm revenue protection is a new risk management program that was created through the 2014 Farm Bill. And after that, we're going to talk about NAT, which was also reformed through the 2014 Farm Bill. And these are two new options that have not been available in the past that are really changing the structure of risk management programs for specialty crop growers and are changing some of these problems that we've been talking about. There are new opportunities for specialty crop and diversified producers to ensure their operations and improve their creditworthiness. So let's jump right into the first. So why is whole farm revenue protection important? Well, it is multi-peril insurance, so it covers a lot of different things. So if you have pest-related losses, that would be covered. Weather-related losses, it would be covered. And actually losses in price caused by a natural event would also be covered by this crop insurance policy. It also very, very uniquely incentivizes diversification. I don't know of another insurance policy anywhere that does something like this. It will insure multiple crops at once without requiring you to purchase multiple policies. And the premiums that you will pay will actually be reduced as you grow more crops up to 7 crops. So there's an incentive there. And it will actually cover crops and livestock together. So it covers that diverse operation that's trying to produce sustainably. So what's covered by whole farm revenue protection? So as far as crops, any agricultural product established or produced on your farm operation except timber, forest, and forest products, animals for sport, show, or pets. And it covers livestock up to 33% of revenue or $1 million. And over the last few months, RMA has been requesting recommended changes to this policy that could be implemented in the second year of the pilot. And one of the things that they heard a lot was that the 35% cap on livestock revenue was keeping a lot of farmers out of eligibility. So we hope that in the next year or two that cap will be removed. We don't know this, but we hope that it will be removed, and that will make many more producers eligible for this insurance product. So events that are covered, it insures against loss of approved revenue due to unavoidable natural causes that occur during the insurance year. This includes decline in both crop yield and price, as long as the decline can be linked to a natural cause, i.e. weather-related. And the actual language from the policy says decline in local market price will be presumed to be from unavoidable natural causes unless the company or the FCIC, that's the Federal Crop Insurance Corporation, is able to specifically identify a man-made cause that resulted in a measurable change in the price. So what that means is that there's a bit of a gray area around what a natural cause of is for a drop in price. But what RMA, the Risk Management Agency, is saying there is that they will presume presume a drop in price was the result of a natural cause, unless it's very, very clear that it's not. So a bit of a gray area, but that definition helps a little bit. So what's not covered by whole farm revenue protection? So you can think of these things as unnatural causes. So as far as yield, negligence, mismanagement, wrongdoing would not be covered. The act of a person rather than nature, so chemical drift or fire. Water contained by a dam or reservoir, damage to machinery or equipment. Breakdown in irrigation equipment or practices when not related to natural cause, and theft or vandalism are not covered causes of yield loss. And price loss, causes that are not covered would be quarantine, boycott, or refusal of anyone to accept commodities, lack of labor, deterioration of commodities in storage, unless due to unavoidable natural causes. So those are things that would not be covered by whole farm revenue protection. And again, you can think of them as unnatural causes of loss. So why did prior whole farm revenue crop insurance policies not work? It should be known that whole farm revenue protection is not the first time we have had a whole farm policy. There were two prior policies that were available all the way up through the 2014 crop insurance year, and those were called Adjusted Gross Revenue, or AGR, and Adjusted Gross Revenue Light, or AGR Light. And they were really underutilized nationwide, and especially in North Carolina. One of the problems was that these policies were geographically limited. There were many farmers in many states that were not eligible for the crop insurance policy simply because they were only made available in a few locations. The coverage was limited. You could only insure 72% of your average adjusted gross revenue, which was less than the coverage that most farmers were looking for. Based on the cost of the policy, few farmers expected to ever have a loss that was going to be significant enough that it was worth their premium costs to purchase the policy. So along these lines, it was expensive. Producers frequently reported the policy was not cost effective for them. There was difficulty expanding coverage. Producers were required actually to show a history of crop insurance, or excuse me, of crop expansion in prior years before being able to expand coverage. So even if you had had steady production over the prior 5 years and you had a new buyer that was going to allow you to expand your operation, all of the expansion would be uncovered, essentially leaving your farm pretty underinsured. So that was one of the big challenges that producers faced, that once you had this insurance, it was difficult to expand your operation. There was a low liability limit, so there was a $1 million liability limit. And then only 3 policies, as a result of all of these issues, only 3 policies were sold in North Carolina each of the last 3 years. So again, really underutilized. So let's look at whole farm revenue protection now. This is what we currently have, and all of the states there that you see in yellow are areas where whole farm revenue protection is available, and AGR and AGR Light were not available. So large portions of the Midwest have now been provided a whole farm insurance product that had not had access to it in the past. There's still a region in the Mid-South, 5 states there in the Mid-South that do not have access to whole farm revenue protection currently. However, Secretary Vilsack has said in Congress, has testified in front of Congress within the last several months that the USDA and the Risk Management Agency is working to expand whole farm revenue protection to those 5 states in the Mid-South. So that would be a huge thing for those producers in the Mid-South that don't have this whole farm insurance option. But we, based on what we hear from Secretary Vilsack, we think that the policy will be expanded soon, hopefully by the next crop insurance year. So let's take a close look at the differences between AGR Light, AGR, and whole farm revenue protection and sort of compare. All 3 of them are revenue coverage, so it ensures your farm's revenue. All 3 require 5 years of tax history, so your revenue is based on your average of your 5 years of tax history. They all have this diversification incentive that allows you to include new crops and receive a premium reduction. And the coverage level is where we start to see some changes to the whole farm policy. And you see those changes listed in red there. So the coverage level for whole farm actually goes up to 85%. And that's more, of course, than an 80% coverage level, but it's made even more significant when you look at the payment rate just below. The payment rate for whole farm revenue protection is 100%. So you can sort of think of this as like your co-insurance. What this means is that 85% of your coverage is going to be paid out fully to you, 100% of that coverage level that you purchased. Under AGR and AGR Lite, the best you could do was a 90% payment rate. So you had 80% coverage, and then you had a 90% payment rate below that, which meant your coverage was essentially more like 72% coverage. So it was a bit complicated, and meant that farmers sometimes were not receiving the payments that they thought they were going to get based on the coverage level that they had. But the 100% payment rate under whole farm clears up some of that confusion, and it means that the 85% coverage level is a true 85% coverage level. Perhaps most significantly, actually I think I will say outright most significantly, the maximum subsidy under whole farm revenue protection went up from 59% to 80%. What this means is that 80% of this policy is paid for by the taxpayer and the federal government, and that the farmer only pays 20% of the premium. And because the payment rate, or excuse me, the subsidy under whole farm went up to 80% from 59%, it means that this product is much cheaper than AGR and AGR Lite. So if you're a farmer that looked at AGR and AGR Lite and thought, that's not cost effective for me, looking at whole farm may be worth your time. It will be a significantly cheaper product for you. It does cover post-production expenses. With AGR and AGR Lite, we found that farmers were having to back out costs like packing and packaging and washing and labeling that they were doing on the farm, but after harvesting. And whole farm revenue protection doesn't require that farmers back out the costs associated with those things. So this product is actually getting you closer to ensuring your actual revenue. And then the liability limit has gone up significantly as well. There was a $1 million liability limit under AGR Lite, $6.5 million under AGR, and whole farm revenue protection is actually at $8.5 million. So you can insure much more revenue under whole farm than you could under AGR Lite or AGR. But how much does it cost? So this is the question that we generally get first, and it should be the first question. And the answer to this is it depends. Unfortunately, the answer is not really easy, but we'll do our best to give you an idea. It depends on how much revenue you want to insure. It also depends on the premium level that you want. So your price will be different based on choosing an 85% coverage level or a 70% coverage level. The specific crops you grow and how they interact will also affect the price. And how you grow crops, whether you have more diversity or less diversity, will also affect the price. Ultimately, the price must be settled with your agent. What we tell you here today shouldn't necessarily be taken as an exact indication of what your premium will be, but you should talk to a crop insurance agent to find out exactly. For your own purposes, if you just want to run your farm numbers through a tool to find out how much this would cost for you, you can do that on the USDA's website. And that tiny URL that's provided there, you can copy it down and put it into your web browser, and that will take you to the USDA tool that will allow you to run your farm numbers on whole farm revenue protection and get the cost for your farm. But let's take a look at an example scenario right now so that we can try and get a sense of what this policy might cost. What's the ballpark? So in this model farm example, we're going to take a mid-scale specialty crop commercial operation. The farm has $1.2 million in revenue a year and is on 215 acres. And that $1.2 million in revenue is split evenly across 3 crops: cucumbers, bell peppers, and tomatoes. And if you look down at the bottom, what you'll see is the producer paid premium based on the insurance coverage levels. So let's look at the 75% coverage level, for example, and we'll see that the total premium you would pay for this crop insurance product, if this was your farm scenario, this $1.2 million in revenue, would be $24,300, and the per acre cost would be $113. So let's look at a little bit different example, and this will help us illustrate to you how crop diversification impacts your premium. Let's say that same farm with $1.2 million in revenue adds watermelons, but they only add $30,000 worth of watermelon revenue, and that's going to be 3% of their overall revenue. Let's look down at the bottom of the slide at the 75% example again. This is 75% coverage level for your insurance. The total cost of this insurance in this scenario would be $24,660. Now, there is a difference there of about $360 more than the first example we gave with only 3 crops. And this is confusing, right? You know, we've been saying that as you increase the number of crops, your premium goes down, and you've increased crops here and your premium just went up. That doesn't make any sense. Well, the reason it went up is because watermelons don't account for a significant amount of your revenue. It's a very, very small amount of your revenue, so you've not really diversified your crop income very much, even though you've added a crop. And so since some of your income has been diverted from cucumbers, bell peppers, and tomatoes without really diversifying your overall income, the cost of this product has gone up for you by about $360 total. Let's look at the next example. And this really illustrates what happens to your premium if you concentrate your crop income in just a few crops. So we're looking back at the original example again with just the 3 crops: cucumbers, bell peppers, and tomatoes. But in this scenario, your crop income is really concentrated in cucumbers and tomatoes. About 84% of your income is coming from cucumbers and tomatoes. And with this 75% coverage level example again, at the bottom of the slide, the total cost for that farm would be $26,460, and that's a difference of about $2,160 more. So because bell peppers count for such a small amount of your crop income and the rest of your income is concentrated in 2 crops, this scenario is going to cost you more than the first scenario that we gave you. And then finally, let's look at one more example of what really combined diversification looks like. So we say combined because we mean crop diversification and income diversification. And this is really what RMA is looking for in this policy. We've added another crop. We've added watermelons, and we've added $300,000 in watermelon revenue, and that means that our income is spread evenly across all crops. Each of our crops accounts for 25% of our revenue. And if you look at that 75% example again, if you wanted 75% coverage, the total cost of this policy for this farm that makes $1.2 million in revenue a year is $23,580. And the difference there is actually $720 less. So by adding an additional crop, you have reduced the overall cost of your insurance by $720. So how can I calculate premiums for my farm? We showed you this earlier. I just want to show you this again. This is the tiny URL that you can copy down and put into your web browser, and this will take you to a USDA calculator that will allow you to calculate this for your farm. And we're going to take a look at what that looks like right now so that you are prepared to use the tool when you get an opportunity to run your farm numbers through that. So we're going to click on Quick Estimate. This is the screen that you'll see on the USDA's website. And down under Most Used Links, you'll see Quick Estimate, and you want to click that. And you will see some options like this: commodity, commodity year, state, county, type, and practice. And you will want to fill in your information. And for commodity, you'll want to put whole farm revenue protection and fill in the rest of your information. And on this screen that you'll see next, you have some more information to put in. You have your MPCI liability. You'll want to put in 0 for that unless you have other crop insurance on your crops as well. And you have your allowable revenue, which will be based on your historical revenue for the last 5 years. So you'll need your last 5 Schedule Fs, and you'll put that information into those boxes. And then you will go through your drawing this year and put in your commodity values, and you will get your expected farm output report and revenue. And that is going to bring you to this screen here, which is going to give you the cost of the insurance at the various premium levels. You see that down at the bottom. And you can also click on some different tabs just above that will show you the producer premium amount. It will show you the subsidy amount, which is what the federal government and the taxpayer is covering, and you can also click on the total premium amount. The worksheets will give you more specific information about your farm, and you'll be able to take some of that information to a crop insurance agent that you may want to talk to about purchasing whole farm. So what additional reforms are needed? I've mentioned that this policy is new. It was required by the 2014 Farm Bill. It's in a pilot year now, and then RMA is still working on reforms during the pilot phase. So what do we need to work on? Well, the first, I think, is that beginning farmers do not have access to whole farm revenue protection until the 7th year of farming. That is because there are 5 years of Schedule F tax records required. Your farm needs 5 years of tax history and 1 lag year in order to access this this policy. There is not an option to build a history using transitional yields or county averages, as there are with many other policies. So we're working right now to figure out how to make this policy available to beginning farmers, and to the Risk Management Agency's credit, they recognize that this is problematic and have actively engaged in many conversations about how to make the policy available to beginning farmers. So let's talk about NAP. This is a non-insured crop disaster assistance program. Let's give an overview of some of the changes that were made to this program. So you can purchase NAP on a crop-by-crop basis. So instead of insuring your whole farm, like whole farm revenue protection, you're just purchasing NAP on a crop-by-crop basis. You can purchase 50 to 65% coverage of your yield, and there are no price changes within that 50 to 65% range. That's a significant difference from what farmers historically knew as NAP coverage. Historically, NAP was 50% coverage at 55% of the price. So essentially, your farm was insured at about 27.5%, which is the reason farmers like to refer to NAP as not a penny, or say things like a NAP indemnity payment was enough to take your family out to dinner. Those things were not far from the truth. It wasn't great coverage. So to have 65% coverage and a 100% payment rate for NAP really significantly changes this policy and the kind of program it is for farmers. NAP only uses USDA official wholesale prices, so data and record keeping are very important for NAP. NAP is managed by the Farm Service Agency, not the Risk Management Agency, which is an important difference. So you don't buy NAP from a crop insurance agent. You purchase NAP through your Farm Service Agency office, and I should say that NAP is not technically an insurance product. It is a risk management program, but it is not technically insurance, since it's run through the Farm Service Agency. As I mentioned just a moment ago, record keeping for NAP is really critical. NAP requires a daily record of pounds of each crop sold at the end of each season, and 4 to 10 years of established yield. You can use county averages in most cases, but there is a penalty. But what that means is that beginning farmers can be covered by NAP, since there is not a requirement that producers use their own history. Beginning farmers can access it. Although it's with a penalty, they can't access it. There is a maximum payment of $125,000 per farmer per year. And for this past year, the sign-up was in late November. But on most years, NAP has rolling deadlines depending on the crop. So what you would want to do as a farmer interested in NAP coverage is contact your Farm Service Agency office for your county or your region and inquire about the NAP sales closing dates for the crops that you're producing. So let's look at a NAP example, sort of like we did with whole farm revenue protection. And let's imagine a farm with cucumbers, greens, and strawberries. We're going to look at the strawberries since we insure on a crop-by-crop basis. Strawberries are the highest revenue crop on this farm with an expected revenue of $2,975. The premium calculations will work as follows. Let's assume you have 233 4-quart buckets, approved yield, and a maximum coverage of 65%. And we're gonna use this data to calculate the premium. So we'll multiply those 233 4-quart buckets by $7.6. That's the wholesale price from USDA, and we'll get a total revenue of $1,771 expected for strawberries. And we're going to cover that $1,771. Sorry, there's a typo there actually. So let's do the math with $1,711 and multiply that by the 65% coverage level. So what that means is that we're going to have $1,151 insured. That's the insured amount of revenue we have for strawberries. And we take that insured amount and we multiply that by 5.25%, which is the premium rate mandated by the Farm Bill, that 5.25%. And that gives us $60. So that's the premium rate for this $1,151 in covered income. And then we actually have to add to that a $250 administrative fee per crop. So for strawberries, the total cost to insure $1,151 in revenue is $310. And then after the subsidy, the farmer pays 40% of the premium, and so you multiply 310 times 40%, and that gives you $124. And important for beginning farmers, the administrative fee is actually waived for beginning farmers. So if you're a beginning farmer interested in NAP and this looks like it may be a lot for you to pay as a beginning farmer, you can actually back out that $250 from this equation, and it will pretty significantly reduce your premium and hopefully make this product pretty affordable for beginning farmers. There's a decision tool that farmers can use for NAP as well, like there is whole farm revenue protection. This can be found on the USDA's farm service agent provided on this slide. Again, just copy that down and put that into your web browser. And this tool will help you determine whether or not NAP is available for your crop in your county. In general, it should be available for your crop in your county if there is not a single crop policy available, meaning there's not a policy that the risk management agency has developed that covers your crop. So, for example, in North Carolina, if you grow blueberries or if you grow apples, there are single crop policies for those crops, and so NAP is not likely to be available in your county for those crops. However, if you grow strawberries, there is no single crop insurance policy for strawberries in North Carolina, so NAP would be available. And then you can also use this site to get an estimate on your premium for NAP, as I mentioned. So let's do a recap. Crop insurance can replace part of crop income when it's lost as a result of natural events. That's basically what crop insurance is there for. It's the safety net. The second thing that crop insurance does is it can be used as a tool to increase your creditworthiness. It can help you when you're talking to a lender about getting a farm ownership loan or a farm operating loan, because that lender knows that you have some guaranteed income, and it allows you to access credit without putting your land or your home up as collateral on that loan. So it's a safety net for you in that way as well. So we talked about two products for specialty crop and diversified producers. The first was whole farm revenue protection. It ensures the revenue of a farm. It provides a diversification incentive in the form of lower premiums for diversifying your crop income, but it does not cover beginning farmers. NAP, on the other hand, does cover beginning farmers. It is an FSA risk management program covering crops that do not have a single crop policy, as I mentioned. And if you're a beginning farmer, it will not only cover you, but the administrative fee will be waived, and so hopefully it will make NAP a more affordable product for you as a beginning farmer, and can help you both in terms of a safety net and a way to build your creditworthiness. So with that, I will conclude my portion of the webinar, and my information is on the screen here. Please, anytime, feel free to email me at the email address listed there, or call my office number. I'll be happy to answer any future questions that you may have about crop insurance and how it may provide a safety net for your farm, or an ability to increase your creditworthiness. So with that, thank you.
Yes. Thank you, James, and thank you everyone for attending, and look for our other two webinars coming up in the near future or their recordings. All right, bye.